So, how should you play this space? Let's ask Gerber Kawasaki's Ross Gerber. Hi Ross, let's start, if we may, with Rivian, that big news electric truck startup. One analyst recently likened it to .com boom and bust pets.com. Would you agree?
No, I lived through that period of time, and companies like Pets.com really didn't ever really have much of a business. It was mostly an idea. Where Rivian is actually really close to going into full production of their vehicles right now. They're actually supposed to be producing vehicles already. So Rivian is really going through the growing pains of getting your ramp of your vehicles going, and that is a very difficult period of time for an electric car maker, and they still have yet to prove they can make trucks and scale.
Traditional car makers like Toyota, Volkswagen, General Motors are investing hugely in electric production now. So aren't they going to overtake these EV-only startups?
I don't think so, and it's mostly because I think to be successful in the EV business, I think you have to be all in your company to EVs, and I think the companies that are making ICE or gas vehicles don't have 100% of the incentive to see their electric vehicles be as successful, because it would cannibalize their more profitable gas car business. So we think that the companies that are most committed to EV production and scale will be successful, but the ones that are sort of doing this, I would say halfway or because they're forced to, I don't think are going to be successful.
But the traditional car makers are making electric vehicles at much more accessible price points, aren't they? Whereas Tesla, which I know is one of your favourite companies and is 8% of your ETF, doesn't really seem to be marketing cars at a mass market. So doesn't that produce a difficulty?
Well, no. First of all, the traditional automakers are not selling EVs in any scale. The only company in the world selling EVs in scale is Tesla, with a run rate of 1 million cars a year and growing substantially with 2 new factories opening. So Tesla is really the only player in the EV game in any scale today. And we're still waiting for other competitors to be able to make 300,000 cars a year versus the 20 to 30,000 cars that we're seeing from most companies. We're very bullish about a company called Polestar, which is the Volvo spinoff of their EV company, which is already in production of vehicles and making a very nice car. So I still think there's so much demand for electric vehicles. Any company that can make EVs in scale that look good and perform well will do well. That's not the issue. So EV companies aren't really competing against themselves. They're really just taking business from gas cars.
And as I mentioned, there are a lot of different ETFs in this space, and it can look a bit confusing for the investor. So how's best to play it?
Well, it's obviously best to play it in my ETF, GK, because we have about a 20% allocation to climate change and EVs and transportation. So we're a very pure play for direct exposure in this sector. There's other ways to play it, and obviously Tesla being the best exposure overall in that sector. And then there's several other ETFs, one of which we own a lot of within my ETF and individually for clients is the LIT ETF from Global X, which gives you exposure to battery makers and suppliers, which we're extremely bullish on and serving the entire industry.
Thanks so much for that insight, Ross Gerber, founder and CEO of Gerber Kawasaki.